Uranium Royalty Corp is currently trading at 5.69 Canadian dollars, and it is getting absolutely hammered, down a staggering 10.82% on the day. This isn't a small dip. This is a violent, company-specific event. And here is the immediate, glaring insight that should have every holder on high alert. This is happening while the entire rest of the uranium sector is screaming higher. We're seeing names like Energy Fuels and Denison Mines rallying hard today, yet URC is in an absolute freefall. This isn't market noise. This isn't the spot price of uranium pulling back. This is a profound and aggressive decoupling, and it's a brutal dose of reality for anyone who bought this stock thinking it was a simple, safe proxy for the uranium bull market. The general belief, the expectation that has driven this stock up so much over the last year is straightforward. The world is finally waking up to the need for clean, baseload nuclear power. Decades of underinvestment have created a massive structural deficit in uranium supply. Utilities are scrambling to secure long-term contracts. Therefore, the story goes, a company like Uranium Royalty Corp, which doesn't have to deal with the operational risks of digging holes in the ground, is the perfect picks and shovels play. The expectation is that you just buy it, maybe in your individual brokerage account alongside your Apple stock or Fidelity ETFs, and wait for the commodity price to send it to the moon. People have looked at it as a high-growth theme, something more tangible than the wild swings of Tesla stock or the complex valuations of Nvidia stock. But that narrative, that clean and simple expectation, just collided with a very harsh reality. Today's 10.82% collapse, while its peers are rallying, is the market shouting that URC is not a passive proxy for the uranium price. It is an active company with its own balance sheet and its own capital raising needs. And when we look at the most likely culprit, it's not a mine disaster or a regulatory roadblock. The most plausible explanation for this kind of aggressive, volume-heavy selling on a strong sector day is the company's own at-the-market, or ATM, equity program. The company filed to renew this program back in August, allowing it to sell up to $54 million worth of new shares directly into the market at prevailing prices. And what better time to do that than on a day when the entire sector is flying and eager retail buyers are piling in? The expectation is that you are buying from another investor on the Fidelity trading platform or Robinhood. The reality is that you are very likely buying shares directly from the company itself, which is diluting your existing position to fill its own treasury. Let's break down this price action because it's a masterclass in market mechanics. The volume we're seeing today is significant, but this isn't the look of pure, unadulterated panic. It looks like absorption. It looks like a massive wall of supply is meeting the market's demand. This is precisely what an ATM program is designed to do. As the uranium sector gets hot and buyers using SoFi Invest or their Fidelity mobile app rush in, the company's brokers are standing there, feeding new shares into that demand. This creates a massive artificial ceiling on the stock price. It's a brutal headwind that can capsize a stock even in the middle of a raging bull market. This is the kind of detail that many online investing platforms don't highlight. It's the kind of risk that a managed Schwab Intelligent portfolio is designed to diversify away. But for those of us involved in self-investing, this is the homework that is absolutely required. This type of dilution is a strategic choice. From the company's perspective, it's smart. Their stock has had a phenomenal run. They are using that strong share price as a currency to raise capital, which they will then use to buy more royalties and more physical uranium, thus growing the business. The expectation is that management's job is to make the stock price go up. The reality is that management's job is to build the long-term value of the company, and sometimes that means using the high stock price to raise capital, which causes short-term pain for existing shareholders. This is the kind of nuance that separates a simple Robinhood stock trading mentality from a professional investment strategy. A trader on the Interactive Brokers platform would see the ATM filing and understand that this weakness is manufactured, creating a complex trading dynamic. Someone just checking investing sites for top uranium stocks might buy URC based on the story, only to be run over by the company's own treasury department. This is why the specific tools you use matter. Your Fidelity brokerage might provide advanced charting to see this divergence, while the basic Robinhood app might just show you a scary red number. Platforms like SoFi, which are expanding into SoFi Investing and SoFi Stocks, are bringing new people into the market. But today is a lesson in the risks that lie beneath the surface. This isn't like buying SoFi ETFs that hold hundreds of companies. This is a single, concentrated bet where you are directly exposed to management's capital allocation decisions. This isn't like the drama of Robinhood crypto trading, which is pure sentiment. This is corporate finance. And today, the finance part is winning out over the sentiment part. Even for those with Fidelity Wealth Management or a sophisticated intelligent portfolio, a holding like URC requires constant monitoring for precisely this reason. So let's briefly clarify what Uranium Royalty Corp actually does, because it's central to this whole thesis. The company is not a miner. It doesn't operate the McArthur River or Cigar Lake mines. Instead, it's a specialized financier. It provides capital to miners and in return gets a royalty, a right to a percentage of that mine's future revenue or production, often for the entire life of the asset. They also have a large strategic inventory of physical uranium that they bought at much lower prices. The expectation, as we said, is that this is a safer model, insulated from the operational costs and risks of mining. The reality, as today proves, is that it has a different set of risks: financing risk and dilution risk. To buy more royalties, they need more capital. Their only two options are debt or selling new shares. With the stock price high, they've clearly chosen to sell shares. This is a level of investment help and analysis that a simple SoFi robo-advisor can't provide. It requires active research. This is a painful day for URC holders, but it's a fascinating and crucial moment for anyone invested in the uranium theme. It really tests your conviction and your understanding of the business model. Comment below with your thoughts. Do you think management is making a smart move by selling shares at these highs to fund growth, or do you feel it's a betrayal of shareholders on a strong sector day? Let me know what you think. Now, let's look to the future. Where does URC go from here? This 11% drop opens up a few distinct possibilities. Scenario 1 is the bullish case. The expectation is that the dilution is bad. The reality could be that this is a brilliant temporary move. The company raises $54 million at a fantastic price, suffers this short-term drop, but then turns around and uses that capital to acquire a new, world-class royalty on a Tier 1 asset. In this scenario, the long-term value creation from that new asset will far outweigh the short-term pain of the dilution. Investors who understand this and use their Interactive Brokers account to buy this dip, knowing why it's dropping, could be handsomely rewarded. The company's net asset value per share would increase, and the stock would eventually re-rate higher. Scenario 2 is the bearish case. The expectation is that the dilution will end. The reality could be that this ATM program becomes a permanent wet blanket on the stock. The market now knows that every time the stock starts to rally with its peers, the company will open the taps and sell more shares. This would cause URC to perpetually lag the sector. Professional investors using the Interactive Brokers tools would spot this trend and rotate out of URC and into the producers like Cameco or Denison. The stock would become uninvestable for momentum traders, and those holding it in Fidelity IRAs or other long-term accounts would face chronic underperformance. Scenario 3 is the middle ground. The company completes its $54 million raise over the next few weeks, the selling pressure from the ATM abates, and the stock is unlocked to trade more closely with the uranium spot price and its sector peers. The drop today is a painful but finite event. The question for anyone doing SoFi active investing or managing their own Fidelity investments is whether you can stomach the volatility and the uncertainty until that supply is fully absorbed. The low interactive broker's fees might make it tempting to trade, but the risk of catching a falling knife is high. This is the kind of event that makes Robinhood cash management features look appealing, as cash is the only position that isn't bleeding. Ultimately, the thesis for online investment in the uranium sector remains strong. The fundamentals are intact. But the thesis for URC specifically has been severely challenged today. The expectation was that you were buying a simple, safe proxy for the commodity. The reality is that you bought a complex financing vehicle that is actively using your enthusiasm to dilute your stake. This disconnect is where the danger lies. This is why invest online strategies must be more sophisticated than just buying a theme. Whether you're using Fidelity mutual funds, Robinhood